So Warren Buffett also looks for attractive price, value plus margin of safety. Buffett doesn't pay fair value prices. He looks for great businesses at a great price that gives him room for error. So he looks for value, not just quality. A wonderful company can still be a poor investment if the price is too high. He compares price to the business's intrinsic value, what it's really worth. Two, he buys below intrinsic value. Buffett wants to buy at a discount, typically 20 to 30% below intrinsic value, possibly during a recession or a major pullback. This margin of safety protects against mistakes and unexpected problems. Be greedy when others are fearful. He looks for opportunities when good companies are unpopular and out of favor. Fear causes prices to fall, creating the best buying opportunities. How he judges if the price is attractive. Price to earnings, lower PE than the company normally range and their peers. Price to book, looks for solid businesses trading at reasonable multiples. Free cash flow yield, prefers companies that generate strong cash flow for the price he pays. Margin of safety, buys at a price that he leaves a cushion that things don't go as expected if things don't go as expected. So key questions Buffett asks: am I paying less than the business is worth? Possibly during recession, you get a discount, a sale price. Is there a margin of safety if I'm wrong? Would I still buy if the market stayed pessimistic, especially during a recession? So here's some examples. Apple, Buffett saw a dominant brand, loyal customers, huge cash flow, and a stock trading below its long-term value. He bought in approximately 2016, about 96 to $105 a share, bought them and then sold it in 2018 around $175 plus for a great gain. So rationale, massive cash pile and free cash flow, strong brand ecosystem lock in, trading around 9 to 10 times earnings at the time, high return on equity, above 30%. The result, Apple has been one of Berkshire Hathaway's largest winners. The stock has multiplied several times since Buffett first bought it. Next is Bank of America. So what he did here is purchased in 2011, 2012, right after the financial crisis hit, saw the opportunity, waited for the prices to fall, and I'll talk about that later in terms of looking at the market during this period of time, started buying, and then also from 2012 to 2014, he made approximately from the stock was around $5 to $8, and it went up to about $16 a share, so a 2x return. So, simplified rationale. Great bank with a strong brand, very cheap price. Problems were temporary. Buffett believed it would recover and be much more valuable later. The result made billions of dollars for Berkshire. The stock price returned to normal levels over time and one of Berkshire's most profitable investments. Key takeaway, Buffett buys great businesses while others are fearful and the price is low.